Hello, everyone. I am Rachel Deschelle, Senior Manager of Trading Services and your host for Long Options. This is a class where we focus on option buying strategies, and we make the assumption that you are already familiar with the concept of long options. So if you aren't, you are more than welcome to stay around, but you may want to check out our Getting Started with Options playlist first. So I am joined today by Brent Moores in the chat. Please feel free to chat in your questions, comments, requests during today's session. I'll be on the lookout for those. And please feel free to follow Brent and us on X. I am Rachel-CS and Brent Moores is Brent Moores CS. We post a lot of charts, a lot of different ideas, so you can follow us all on there to get the updates. And please subscribe to us on our Trader Talks channel as well. So before we start today, we're going to really focus on the concept of using the Theo Price tool and the Analyze Risk Profile tab to really simulate a theoretical price for the option or a theoretical max gain or max loss, depending on the price move of the stock, volatility factors, and time. So that's what we're going to focus on today. But before we get started, let's dive into some important disclosures here. So options carry a high level of risk, are not suitable for all investors. And the information we cover here is for general informational purposes only, should not be construed as advice or a recommendation. And we're going to use the Paper Money platform today to cover some paper trades. Just be aware that Paper Money is quite a bit different from the live environment. So now we'll just kind of cover our agenda. So first, we usually start with our market overview. We review our trades. Then we dive into discussing the concept of long options, those factors of price, time, and volatility. And then we'll take a new example trade on the Paper Money platform. So let's dive into Thinkorswim and just start with the first, which is our market update here. So we've obviously seen some selling pressure in the major market indices, especially over the last week or so. And just starting with the Dow, we are seeing that we obviously broke that 50-day moving average here in white. So that's the 50-day. We broke that yesterday, actually, and then we had continued follow through with a teeny bit of a gap down today, almost forming this hammer type candlestick, which is that bullish reversal type pattern here. I'm going to highlight it here so you can see it a little bit more, but that's where it has a very small body up near the top of the candle. Obviously, we still got a couple hours of trading today, but it's still seeming to hold that 100 period moving average there. So we would have to look through a little bit of follow through tomorrow to really see if this is a validated hammer candlestick that occurs kind of at that bottom of price. But that next resistance is really going to be that 46,645 level right around the 50-day simple moving average. But again, no lower lows were made. So we technically still have a strong structural uptrend here. I would say if that trend continues, if that candle is invalidated and we find the 100 period moving average, we're probably testing around this level as well, which are these lows from October coming in at horizontal support there. Now let's move over to the NASDAQ. That has had a little bit more of a kind of a pullback here just from its highs. We've seen that it actually broke through yesterday, broke through the 50-day moving average. Same with the Dow. We see momentum declining to the downside, now kind of putting us in this a little bit bearish regime for momentum where we're below that 50 level that we've really been at really since those April lows. So that's kind of something we're seeing to the downside there, is just continued momentum. But yet we're still holding this horizontal support right around 22,200. And today it's looking like we're forming a little bit of a doji candle, which we all know as technicians, that is more of an indication of a pause or possible reversal, especially if it forms at a level of support or resistance. And we see that doji really forming at that crucial level of horizontal support there. Now let's move into the last index here that we're going to cover, the S&P 500. So also same type of action, broke through that 50-day simple moving average, but still, I mean, making a lower low and a lower high in the near term. So we can see this was the high that was made. That's the next lower high. That's the low. This is the next lower low. But that's just from the trend from roughly 3 weeks ago or so. So that's really the short-term trend showing that it is down. But if we just zoom out a little bit further, we can see that the structural trend is still intact. We are still making higher lows all the way through this trend to the upside, higher lows, still holding that horizontal support there. So I would still consider that a higher low. Really not a break in the trend there. Also kind of coinciding with that 100 period moving average. And that's right around that 65.50 level where it's forming a little bit of a hammer pattern, which is kind of what we saw on the Dow as well. So could be a possible pause, could be a possible bullish reversal from that level of crucial support there. So that's kind of our market overview there. And let's just get into reviewing some of our trades from the previous week. So I'm going to go to the monitor tab and just take some time to review these. If we look under the long options section, last week we placed a LEAPS options trade on TJX. So you can see we're down a little bit on that, but we're holding that until the 15th of January of 2027. And let's just look at the chart real quick for TJX to just kind of see where we're at. So TJX broke out to new highs after this really rectangular pattern that really took shape there, broke out of it, and now is dipping back a little bit down. It's still above its 50-day simple moving average. It's still making a higher low. So this trend is still intact. It does have earnings coming up on the 19th, so that will definitely be something to watch here, kind of leading into earnings. Now let's take a look at another trade that we placed the week before. We bought 2 long puts for the 20th of February 2026, the 45 strike puts there on SMCI. And just as a reminder, this is kind of what we were looking at on the chart with SMCI. I'll zoom out here through the noise and hide this RSI here just so we can see a little bit better. But we basically called out this triangle pattern that was taking place, and we took our position when it broke, I believe, 2% below that trend line support there when it made that move to the downside. And we took that measured move that we said could take us all the way to those yearly lows right around 265. But we also kind of called out a couple other levels that may act as support on halfway down the way here, which is these kind of lows from April and May, kind of around that zone. And then we mentioned that we were putting our stop really right near the kind of support line that we saw with the pattern, so that if price failed and re-entered the pattern, that was where we were going to get out of that trade. But I'll kind of show you what I did in the meantime throughout this week, since we have had that continued move to the downside. So essentially what I did with SMCI is I turned that conditional order based off of the stock price moving up back into the pattern. I changed that to a stop market order, saying that we're putting our stop right around 1170. And right now, actually, SMCI has pulled back a little bit from, I guess, kind of earlier, even today, where the mark price is now trading at 1192. I placed that tighter stop just to really still make sure I take advantage of any profits here in this trade, since we do have a sizable profit here. So there's nothing wrong with taking a profit there. Obviously, we don't want to kind of leave our stop or our exit if it retraces that entire move back to the upside. So allows us to take advantage of that. And then we still have that conditional order on the profit to the downside if that move continues. So that's just kind of our review there. So we may see a stop out today. We may not. We shall see. But those are our two trades that we have been in. Now, I have a couple, I have one for you today. We're just going to go through one example trade because we're going to look a little bit more in depth at the Theoprice tool and the Analyze Risk Profile tab, like I said before, to just really simulate an option price's values based on changes of implied volatility, based on movements of the stock, and really based on those changes in time decay and implied volatility. So I'm going to look at Amazon here. Amazon has been one of those that really was range bound for quite some time and then gapped above its former highs after that earnings announcement really roughly 3 weeks ago, and then almost made the measured move to the upside actually from the depth of this pattern. And then really since then, after it made those new highs, it really pulled back and is now actually struggling with its 50-day moving average and its 100-day moving average, which those both actually look like they're about to curve down as well. So we can obviously see that gap has been filled. That earnings gap was filled in less than 2 weeks. That becomes an exhaustion gap, showing that that trend to the upside was exhausted. Obviously seen a bit of a reversal. And honestly, since these moving averages have been broken at this point, really the next support level I see to the downside could really be this former support where we saw those lows being carved out on October 17th and August 4th, right around 211 or so. So that would kind of be the area that I would kind of look at to the downside after some of those significant moves were made. The significant moves meaning the gap closure, the fact that we're back in the box, the fact that we are now trading below the 20, the 50, and the 100 period moving average. That next level of support looks like a little bit more of that move to the downside, roughly around like 13 points or so. So if I wanted to take advantage of continued bearish action in this, because one thing I may look at too is momentum to just see how strong that bearish action is to the downside. And we are clearly seeing RSI is still pointing down. We are not making, we're really underneath that bullish regime of 50. So right around 41 or so. And that kind of indicator just kind of pointing down to the downside. So obviously momentum is confirming with the trend there as well. So another thing to watch. So if I were to take a directional stance in this, my evidence kind of leads to the downside here for Amazon. So what I'm going to look at as well is maybe kind of taking a long put trade that gives us a little bit of time for it to reach that level where we don't see too much time decay, where we can really take advantage of a quick down move in price should that continue. So let's take a look at the trade tab here and let's look at Amazon. So I want to give myself more than a month's time because at that month kind of period or zone, that's kind of when time decay tends to kind of pick up its pace in high gear. And I'll kind of show you that as we look at the theta column on this option chain here. We can obviously see the theta of the at the money options looking like they're around 14 on the put side here. Now, if I just collapse this column, obviously just take another look. Obviously not going to trade this because it's only 3 days till expiration, but just to kind of show you the acceleration within that 30-day period of that time decay or that movement of that option theoretically with each day passing, that's going to get much larger than what we just saw on the 30-day out. So next, I'm just going to take a look at the one with the 16th of January, 59 days out from expiration, and take a look at my theta decay here. Now, it is still less than what we just saw on the 30 days out, which was right around, we saw 14, 16 or so. We have really a theta decay of 9 cents. So with each passing day, our option that we hold it, theoretically, if all things remain the same, no changes in IV, no changes in really the direction of movement of the stock, we would lose, holding that option, we would lose roughly 9 cents per day there. So we're kind of going to go with this one and use this as our example just because it gives us a little bit more time, and we would probably like to close it out roughly around, I would say probably that 20 to 30 day mark, since that's when time decay really tends to kind of accelerate in that fashion. But what we're going to look at is just simulating if we did see that move down to that 211 horizontal support that we just saw on the chart, what that would do to the price of our option. So we're going to use this filter here. I have it set for a custom filter, or I guess a custom column set for the Greeks, volume and open interest there. And we can see Amazon. We know it's a very liquid stock. It trades more than 36 million shares a day, kind of what we're seeing there climbing. And then we obviously have a ton of volume, a ton of open interest, so very liquid options. I'm not too worried about looking at those right now since I know that they're pretty liquid. So I'm just going to shift to Theo Price Mark here. And this will kind of give us a way to pick a date and time for the time that we're holding this option. Pick a direction of the stock movement and pick a volatility adjustment here to really simulate what the price of our option would do over the life of the option. So if I click on Theo Price here, and I just look at what's today's date, we are on the 18th right now. So if I just say we are looking a week out from now, so the 25th of November, and if the stock price goes down, let's say $5 in price or $5.50, let's say it just makes half that move over the next week, that we would be possibly looking for towards that level of support just over the next week. Whoops. This will give us on the right-hand side, this will give us obviously the spread of the option, the bid-ask spread, and give us the mark price of that. But then it will give us the mark price of that theoretical price to really show that move and what it would kind of take to that price just if a week has passed, there's no volatility changes whatsoever, and that stock price makes a $5.50 move to the downside. So obviously we have quite a bit of a move there. And you'll notice too, because when we looked at the Greeks before, which are obviously not shown here right now, our at the money option right around that 225 is going to have the delta that's the closest to 50. And so with each dollar move to the downside, that option's going to move to the upside roughly 50 cents. And the further we move into the money, like the 230, the 235, the 240, we're obviously going to have a much larger move on that option, especially in percentage terms, as we kind of see that continued move to the downside with the price of the stock. So that's just kind of something to keep in mind there. Now, let's just say with the movement down in price, let's just say volatility goes up a little bit. Let's just say it moves up about 5%. Now look at these filters on the Theo Price, and I'm going to click out of this box here. Whoops. And this will show me just with a 5% change in implied volatility, in addition to that stock price dropping, we're going to see another continued move to the upside with our put option, because we have a pretty Vega positive strategy here, obviously. So we want to buy when IV is a little bit lower, obviously see that IV move to the upside with our long option, and that's going to benefit the price of our long option there. So I'm going to look at the questions here. Okay, so we got, yeah. And then we are not going to cover NVIDIA today. I am sorry. We're going to cover just Amazon for today, but that could be one that we could look at in the coming weeks. And then it looks like Brent, he just answered that question as well as far as time decay. So yeah, it's less about a certain level of time decay because it's going to be different for each stock that you trade, since it's obviously a mathematical formula based on that price of the stock. So keep that in mind. It's just kind of looking at that time decay curve, maybe doing a little bit of a comparison of your strike, or I guess not strike prices, but your option expiration series to really take into account where the time decay is going to be the least, and also how much time you really think it's going to take for that stock price to reach your target to the upside or to the downside too. And you can use, with looking at time decay too, we'll get into a tool here in just a couple minutes looking more on the analyze tab using the risk profile. You can also compare various expiration dates, and which is kind of what we're going to do, and we're going to look through time to see how that time impacts the value of our option or impacts our profitability. So let's take a look at one more thing here. So let's just say it takes 2 weeks for our option to really hit its target that we're looking for. So if we look at December 2nd, and we're looking at a down move of, what was it? Was it $11 or $13? Oh, it was $13. That's right. Because we said 211 was the support. So let's just say we're looking at a $13 move in a matter of 2 weeks, which that's honestly not out of the question, because actually, if we look at the net change today, obviously we're seeing a bit of a move. And another thing that you could do too is look in a matter of roughly 2 weeks here, and it'll show you the implied volatility and expected move here on the right-hand side of your option series. So within really the next roughly 2.5 weeks, that expected move of Amazon could be up $18 or down $18. So that's kind of giving you that expected move there. So let's just say we're looking at that $13 move all the way down to horizontal support with an additional change in implied volatility. Let's take a look at what that's going to do to the price of these options. So we can see obviously a much larger percentage gain there on our Theo price compared to what our mark price would be. So that would be roughly a 50% gain in this option. So you can kind of use that to really simulate where to possibly, theoretically, where you could possibly put your target prices or your exit orders to cap off your losses to the downside on this option too. Because we see with a move within that period of time to our horizontal support, it's roughly going to give us a 50% gain on that option. So it gives us a little bit of an objective there. And then let's just say there's no changes in implied volatility, but the stock price moves up against us. And let's just say it moves up $3 to the upside. And that order keeps popping up there. So if it moves $3 to the upside, and the reason why I chose $3 is because if I go back to the chart here, I look at the price of where the 50 period moving average is and the 100 period moving average, and I can see the $4 move to the upside would be the 50-day. A $3 move to the upside would be that 100-day moving average. So we could say that that could be where we could stop out our losses. So if it moves within that amount over the next 2 weeks, if it moves up $3 or so, our price of our option would be $9.14. Now let's look if it moves there. Let's say if it moves $4 in the next week. So I'm going to move this to the 25th. That order keeps popping up. So if the stock price moves up against us, back above that 50-day, back above that 100-day moving average over the next week, this could put our option price really at this level of right around 950 or so. So if we wanted to keep a tight stop on and possibly place this order for a few contracts of an option that's slightly in the money, this will kind of give us an indication of where we could possibly place that price target. And that's kind of why I'm showing you this here, so you can kind of simulate out these different scenarios. So what I'm going to do, since we've kind of seen how this can impact the price of our option, I'm going to write this down on our scratch pad for possible prices here. So we have the, let's see, for the 225 at the money, we have 955. And for the, let's say the 230, we have roughly 14, or wait, that's 1187. Okay. So that's a pretty tight stop there, because obviously Amazon's price can move quite a bit. So we could give ourselves a little bit more space, obviously, maybe 1-2 percentage points above those 50 and 100 period moving averages, because a trader may look at that as obviously that next level of resistance within that range there too. So that's what we'll look at there as part of formulating our exit. Now, if we just kind of select one of these options, I'm going to go back to looking at the Greeks and open interest here, and I'm going to collapse our left sidebar for now. So if we're looking at these various options, we want an option that is going to be in the money, is going to have a little bit of intrinsic value, is also going to move a little bit more than 50% on the dollar for that particular option. So I may look at the 235 strike put here, which has a delta of roughly 60, really telling me that there is a 60% that the percent chance that this option could expire in the money. And for every dollar moved down in the stock, our option's going to gain 60 cents, which is why there's that negative number there, just because that delta works inversely. So if the price of the stock goes up, the price of our option will move down 60 cents for every dollar moved to the upside. So I'm going to click on this this option here, and we're just going to take one step further, since we already analyzed or simulated what a possible move in some different factors like time, price, and volatility can do to just the pricing of the option. Let's take a look at what it could do to our profitability and our risk on a trade. So let's take a look at the analyze trade graph here. So I just right clicked on that option and I clicked analyze trade. And I'm going to make this a little bit easier to see for us. Okay, so I'm just grabbing the x-axis there, and we're analyzing this trade here. So the first thing you want to do whenever you get to analyzing a trade, you want to double check the expiration that you've selected at the bottom, and make sure that the date in the upper right hand corner is the date after your expiration. So that way all the probabilities, all the risk parameters here encompass your last day of trading. So I'm going to look at the 17th of January here. Okay, 17th of January. Obviously, we have a pretty wide span of where the stock price could go, obviously over the lifetime of our option over 2 months. So what this is really showing us here, for those of you that are new to this Analyzer's Profile tab, it's going to show us the price of the stock on the x-axis down here, if the price of the stock goes up, if it goes down. And then over there on the left-hand side on the y-axis, you're going to see your break even at 0, max loss down here, max gain to the upside as well here. And then you're going to have these two lines. One of them is going to represent your break even, max gain, max loss on expiration, which is this blue line here. And you can kind of see these dates in the lower left-hand corner. So we have the blue line there. And then our risk array today is the purple line there. So we can see that. Now, obviously, just taking a couple things into consideration, obviously our downside risk and our max loss is going to be if the price of the stock is above 235 on expiration. So we obviously see that here, and the most we can lose, we can look at that value in the lower left-hand corner of our graph. We can see the most we are risking to the downside is a premium that we are paying, which is roughly $1,755. Now, we have a lot of upside potential because the stock could theoretically go to zero. So we have as much profit potential with how far the stock actually goes down during that time frame. So you could kind of see as I'm moving my mouse here over the 200, 210, 220, those values are going to change in this lower left-hand corner of what that theoretical gain and loss would be based off of the date that we're looking at and based off of the price that I'm hovering over for a theoretical price move of the stock. So if we had this move, and it's trading at 225 right now, but if we had a move down to 220, we can see here that today we would be at a $232 gain. But on expiration, we would be at a $280 loss just because of all that time decay that we saw with our option there. So that would kind of be kind of our theoretical profit and loss there. Now, another thing you could do here on this tab is let's just analyze a couple different things. So if I go to lines 1 at expiration, this is just kind of the default because it's showing us what the price of or I guess what our risk looks like if we just compare our line today versus our line on expiration. But if we did more of like a day step, we could select 4 lines here. So 4 at day step. And what this does is it actually adds multiple lines for different days. That's all that day step is. And the step is essentially the difference of days between those lines. So take a look at the lower left-hand corner here, and you can see all of those dates of what our risk would look like to kind of simulate this option throughout time. So I'm going to put this as, I'm just going to put this step as 14. So the difference between each of these lines will be about 14 days in time. So let's just simulate that the stock moves down to 215. So let's just say it moves, most of that move down towards our horizontal support, but it loses about $10 in value. Everything else stays the same except for the price movement of that stock. So if it moves down to 215 here, I'm going to put this right at 215, my mouse right there. You can see, you can see that today we would be at a $585 gain. If we let that time pass just 14 days from now to December 2nd, so that's really 2 weeks out, we'd be at $90 less of a gain just because of that time decay that we're kind of seeing there. And you could just see with each 2-week period that passes, we are seeing that initial kind of like smaller profit there because we're seeing that really decay in time over the life of our option and how our theta is essentially going to pick up in a faster speed the closer we get to expiration there. And you could see we got stopped out of our SMCI trade actually. So we took our profits there on that trade. If you just saw that notification there in the upper left-hand corner there, we did see that go through with a fill at 1170. So I think that was roughly an $800 and $900 gain on that option. So at least that stop order was in and protected our gain on the option to the downside there. So coming back over to this tab, hopefully that makes sense on just how you can kind of visualize that a little bit more. I know there's many different ways to look at that on this platform. This gives you a little bit more of that indication. Now, if we were just to also look at, let's say, your volatility changes. If we go to vol step, 4 at vol step, we can actually look how each 5% increment in implied volatility will actually change our profitability on our option. So let's just say the price of the stock goes down to roughly 220. So I'm going to put my mouse right over there during that, over that price area. And we're just going to look at in that lower left-hand corner where we see all those colorful values, starting with our current level of implied volatility, which is 39.5%. So if the price of the stock goes down just $5 and implied volatility goes up, I guess stays the same right now, we would be at a $232 gain. But if the price of the stock goes down to 220 and implied volatility moves up 5% to 44.5, we're obviously going to see a much larger gain there, almost like more than a 50% higher gain than what we would have seen before with just no change in implied volatility. So you can really see through those increments how that's going to affect your profitability, really over the direction of the stock, and then also just as far as how volatility will impact that profitability too. So hopefully that gives you a little bit more of an indication of how you could use both that Theoprice tool and the risk profile graph to really simulate and estimate and visualize how the price of your option will change based on these factors, and then also with how your profitability will change over these factors as well. So let's move to actually placing a trade on this option. So I'm going to hit delete here on the 235, and I'm going to right click on this option, and I'm going to go to buy custom with OCO bracket here. Now, we did a few simulations of where the price of the stock could particularly go. I want to use just a limit order that's going to get executed pretty quickly here because I do want to take this trade here. But we did simulate out a couple different things where we saw a 50% gain if the price of the stock were to go down to a specific point. So I'm just going to put a 50% target in here. So I'm going to take 765 or 1765, excuse me, and multiply that by 1.5. Okay, and that's going to give me 2647. And then I'm also going to take a stop order. We're going to use a stop market order. Obviously, we're going to put in a stop prices, which is really going to be the activation price for a market order. So there's no guarantee at what price we'll actually get an execution at. So that's kind of the risk with that order. But as soon as it hits a certain price, I want to really get out of this trade. And we simulated a little bit of a move, maybe past our 50 period moving average and past our 100 period moving average. So that would give us, let's just say we are going to look at if the price of this option loses 40%. So I'm going to take 17.65 and multiply that by 0.6. And that gives me 1059. Okay. Now, the only problem with this is I have about a little over 6,000 that I could actually place into my trade for my trade size. But I only have roughly a little over $1,000 that I'm willing to risk per trade. So if I did this, this would give me about $700 of risk to the downside. And that would only allow me to place one contract. So if I wanted to place 2 or 3 contracts, I would have to have a tighter stop there to stay within my risk parameters. So that's what I may do here because I'm going to take 2 contracts here. So I'm going to bump these up and I'm going to look a little bit higher for my stop since I know that I can only risk a little over 1,000. I think it was like roughly $1,100, $1,200 within this account. Let me place this order at $12. So that's just taking the difference between the price that we're going to get executed here, 565, or 1765, sorry, minus $12 times 2. That's really what my risk is going to look like. So that still leaves me within my risk parameters there. And this is roughly, I would say, kind of like 3/4 of that price there. So we do still kind of have quite a bit of a tight stop, but with the amount of contracts, we want to make sure we don't risk more than what we can. So I'm going to make this all good till canceled and look to confirm and send the order. So we have 2 contracts of the 235 put at the current price. We also have our 50% gain to the upside there if the price of the stock should go down to roughly that horizontal support. And then we have that tight stop staying within our risk parameters of our account there. So that all looks good to me. We are in the zone there. Let me place this for the long options account so I don't get that confused there. And I'm going to hit the send button there as well. So we are in that trade now. We will track that for next week, but we covered a lot today. We jumped around to a couple different tools here. Hopefully that helped with just going through the theoretical price tool a little bit more to simulate that price of the option based off of all those changes that can impact an options price, and then taking it one step further and looking at your probability or your profitability risk graph and taking a look at more of the visual of how some of those factors can impact your profitability there as well. I just want to thank you, Brent, in the chat there for helping us out. You guys kept him busy as well. And I always love your engagement in the chat. I know you can throw out stocks here or there that you want me to look at. I definitely take those into consideration for our next webcast, since a lot of times we take time to plan these before we actually kind of go through them. So keep sending those in. Those are great. And I just want to thank you guys for tuning in today. Please follow us on X, Rachel-CS, Brent Morris CS, and please like this video. It'll help your algorithm. It'll help other traders who are looking for the same things. And please also subscribe to us on our Trader Talks channel here on YouTube, Schwab Coaching. Thank you so much, and I will see you guys next week.